should you be adding money on to your mortgage? It's a question we get all the time and something that we help people do every single day. You want to know what the answer is? Of course you do. Let's find out. Hey everyone, welcome back to the channel. My name is Adam, I'm an expert mortgage broker, and today we're talking about remortgaging and we're talking about adding money onto your mortgage for different things. Now, if you stay watching to the end, I've got all the information you need to know about the process that we go through to add money onto your mortgage and what's involved. But for now, I've got my top 3 things that we can add money onto your mortgage for. Any questions you've got, please pop them in the comments below and I'll try and answer them on the next video. So house prices lately have been going through the roof. So it's mid-2022 right now and house prices have been going up and up and up for some time. Ever since COVID came along and everyone thought the market would crash, it's done absolutely the opposite. And so many people are making the most of their increased house price. And we're going to talk about how we can do that, how we can make the most of that increase in price. So if you bought your house a couple of years ago, it's already going to be worth more than you paid for it, even if you haven't done anything to it at all. So there's a few ways that we can make the most of your house price increase, and here are my top 3. Now, number 1 is home improvements. It's the big one, it's the most common one, it's the one that everyone wants to do. Should you move or should you improve? Well, we've always been a nation of house owners and a nation of home improvers. There's so many shows on the TV, aren't there, about doing your house up, doing extensions. There's loads of different presenters on there. I sit and spend my evenings watching home renovation shows, like I'm sure loads of you do. So it's really popular to be adding value to our home, and that's the key, adding value. So whenever we're doing home improvements, usually we are adding value to your home. So adding money onto your mortgage to help fund that isn't really going to be a problem because we're adding value to your home. So we might be increasing your mortgage by 20,000, let's say, for your new kitchen and your bathroom, but that's going to add value to your house. So you'll get that back one day. You know, when you come to sell it, you should get that back. Now, we need to caveat that a little bit and talk about the fact that houses will always have a ceiling price. So you don't want to be spending an absolute fortune on gold taps or whatever, loads of expensive things. We need to kind of keep it sensible based on the value of your house. If your house is already worth a couple of £1 million, then gold taps, why not? If your house is worth £200,000, then maybe B&Q. I don't know, other retailers are available. I just mean, you know, normal kind of products, but a nice new kitchen, nice new bathroom, that's always going to add value onto your house. Those are the things that people come into a house and see, and those are the things that make the difference between want to buy your house or not. So adding money on to your mortgage to fund your home improvements is always going to be absolutely fine in my view. Now, that might be a new kitchen, a new bathroom, it might be landscaping the garden, because again, that can add value. Not necessarily value in terms of, you know, bricks and mortar, but saleability. You know, you go and see 2 houses that are saying one has got a really awful garden that, you know, needs loads of work doing. One is lovely and manicured and landscaped and it's got seating and patio area and barbecue and stuff. You know, all that's going to go down really well, and that's going to help you sell your house if that's what you're looking to do. So landscaping is cool, kitchen, bathroom, decorating, you know, carpets, curtains, paint, that sort of stuff. It all costs money, and so if you want to do some of that and you want to spend that money on your house, sometimes it's a good idea to increase your mortgage to do so. The big one, extensions. Adding rooms to your property is always going to add value. Now at the moment, things cost quite a lot of money, you know, building materials and work and finding builders and stuff. It's all a little bit tricky at the moment, but generally speaking still, if you're adding rooms to your house, then you're adding value. You know, you're adding downstairs space, you're adding upstairs space for your double story as well, converting the garage, all that sort of stuff. Anything you do like that, generally speaking, is going to help your house value. So I've got no problems at all helping people fund that by adding money onto their mortgage. Okay, so number 2 then for us at the moment is buying another property. Now that could be another house for you to live in. It could be a second home, a holiday home. It's got a bit in the news actually at the moment about holiday homes and restrictions coming in places. You know, people don't want people, you know, coming from London and buying a second home and you know, pushing out the local residents because it makes it hard for them to afford properties, and it absolutely does. So you know, I don't want to get into the whys and the wherefores of that right now, but people do increase the mortgage to buy another home. It could be a holiday home, a second home. It could be an investment property. It could be a buy-to-let. You may already have some buy-to-lets, or this may be your first one. I've helped so many people over the years get into buy-to-let property, get into investment property. Now, I'm going to do loads of content about investments and things another day, but for now, let's leave it at the fact that yes, you can increase your mortgage to fund a new purchase. Now, you might just increase enough to get a new deposit for a property, and that's okay. You know, if we're going to go and buy an investment property, we need at least 25% deposit, and we need money for fees and costs and things. You can take some or all of that out of your current property, and then you'll just take a mortgage on the investment property for the rest in a normal buy-to-let mortgage. One thing we need to be careful of, if this second home is purely for your own benefit and then you're going to need a mortgage on that home as well, the lender that we go to increase your mortgage with may want to factor in the running costs of that second property. It's different if it's a buy-to-let, because then someone else will be paying that and it'll be generating income for you. But if this is just a second home, we will need to just factor in the other mortgage and the other council tax and the other bills and things that you're going to have on that property. So just a word of caution there, we need to think about those ongoing costs as well. But if it's an investment, a buy-to-let, that's not an issue. Okay, so number 3 is debt consolidation. Now, I've mentioned this on 1 or 2 other videos before. It's a really useful way for some people to reduce their monthly expenditure. Now, debt consolidation comes with a big warning. It is not for everyone. But in certain situations, it can be really beneficial. So the kinds of people I've helped with debt consolidation before. Debt consolidation, by the way, is using your mortgage, increasing your mortgage to repay some other debts. Normally unsecured, so loans, credit cards, possibly cars, although we'll talk about that in a second. I don't tend to like to do cars, but other unsecured debts, or secured as well, because sometimes people have a loan, what we call a second charge, and that's like a second mortgage secured on your house, but it's a loan, so it's not as much as your main mortgage. It's a second mortgage, but we can normally pay that off with your main mortgage when it comes to remortgage time. So with debt consolidation, we're going to borrow more, we're going to pay off those debts. Now, if we've got loans on high interest rates, credit cards where you can just about pay the monthly payment, you know, the minimum monthly payment rather, and we're just about managing those other debts and things. You know, I've helped people before where we've had a mortgage and then we've had, you know, high percentage on credit cards and loans and things, loads of monthly outgoings, and it's been a bit of a struggle each month. But then we've changed the mortgage, and because it's over a much longer term, we can absorb the cost of those other loans into your mortgage payment, and it brings it all right down. Now, what I've found with that before as well is that because that payment is much lower than you've been used to, actually you can probably afford to just start paying a little bit extra on your mortgage and overpaying and getting the whole mortgage paid off that little bit quicker. And that's a really good thing. So it means that, yes, we've added money on to the mortgage to pay these other debts and things off, but you know, if we can overpay over time and get that paid off quicker, it might not be as bad as paying it all over such a long period of time. Now, we have to think carefully with debt consolidation about whether it's the right thing for you. We shouldn't be doing small little loans, you know, less than £500 or so. We shouldn't be adding those on. We shouldn't be adding anything that's 0% onto your mortgage either, because what we're doing is taking that 0% credit card, for example, adding it onto your mortgage and paying interest on it. So we're not paying interest on it here, we're moving it over to pay interest. We need to remember as well that we're taking unsecured debt. Debt that's not secured on anything, debt that isn't going to get you repossessed or anything like that, and we are securing it against your property. So if you don't pay that mortgage, you will get repossessed. The lender will come and take your house away from you. So that is the big risk warning with debt consolidation. It is not for everyone, but in certain situations, it can work, and it has worked really well for a lot of people. Okay, so I said at the start that we would look at the process of how this all works and how it all fits together. So what we need to do to start with is work out how much you owe your current lender. So we'll look at your current lender, we'll look at your mortgage statement, or maybe you could just give them a ring, or a lot of people know roughly how much they owe. So we'll look at where we're starting. And then we'll add up the extra money that we need to borrow. So we'll encourage you to go and get some quotes from your builders, or a quote for your kitchen, or work out how much other debt we've got in the background. Whatever the use is, we'll work out how much extra we need to borrow, and we'll add those two together, and then we'll go to a new mortgage lender and we'll borrow enough to cover all of that. And I always tend, especially if it's home improvements, we need to build in a bit of a contingency. Always try and make sure we've got plenty, and maybe even a little bit left over, rather than coming up a little bit short and then having to find that extra money from somewhere else. We'd much rather see you with plenty to do what you want to do, and then a bit left over that you could always pay back in, because you can always overpay, rather than being short. So we add up how much you owe currently, how much you need on top, and then we do an application with a new lender to cover all of that. Now that lender will have to go through some affordability checks and credit score, just like any other mortgage application. Now there's other videos on the channel where I talk about the mortgage application process and affordability and things, so I'll pop some links in the description for those. But basically, once we know that the new lender will lend you enough money and the credit check has been okay and approved, then the application goes in, the lender assesses everything, and we get a mortgage offer. That mortgage offer lasts for up to 6 months in most cases. There's a solicitor involved as well. It's normally a free solicitor. Again, I talked about this on a video last week about how we remortgage and what the process is. But then we get to a point where we're looking at completion. So that's just the release of money from the new lender. So the new lender gives the solicitor the money. The solicitor then pays off the old mortgage, and then they'll give you the extra money. So then you'll have X amount, however much we've borrowed on top, that'll hit your bank account, and then you are responsible then for paying off those debts, or it'll be yours to go and pay your builders or for your kitchens or whatever you're going to do with that money. So that will end up in your bank account, ready to be spent how you wish. And that, everyone, is the process on moving from one lender to the next, borrowing some more, and the top 3 things that you can spend that extra money on. So I hope that you found that useful. If you want to find out how much extra you could add onto your mortgage, or how best to benefit from the house price value increase for yourself, then please get in touch. Drop us a comment below. There's also a link to book an appointment straight in my diary in the description. The link to our website as well, so you can go and learn a little bit more about who we are at Vantage Mortgages and how it all works. I really hope that we are going to speak to you soon. Until then, take care. See you soon.